Good day, everybody. I haven't made an investing video in a long time. I think a couple months, and a lot has happened. I've made some changes. I've had to reevaluate my plan going forward and what I'm going to do for retirement. We'll get into that later. But a few things we see on the screen right now. I've kind of changed up what I'm buying. I sold out of my position on Cameco, which was the uranium miner. I just didn't see any benefit going forward in the short term. In the long term, I started to lose my optimism. So I just sold right out of that position. And I think I only lost about 40 bucks. And I also sold out of my Shaw Communications position. Shaw looked like it had room for growth, but it was going to be really slow. The 3% dividend, that's okay, but I felt that my money could be better placed elsewhere and bring a higher return. So I sold out of my Shaw and my Cameco positions, and I put all that money strictly into this right here, this Dream stock. This is a REIT. It's a European real estate company, and they're just killing it. I think one or not two of these buy positions you see right here on the screen is where when I dumped my other positions and bought into this one. This stock, even if you trend it, well, this is going back to 2012, but in the last year, at least, they've been killing it, and they just keep acquiring good properties, and they've got a 7% juicy monthly dividend. So this is one of my favorites. If you don't really follow the investing community, as you see on the screen right here, this is ACB, Aurora Cannabis. The medical marijuana industry in Canada has exploded through November. I do believe there was something in the House of Commons or the legislature where they passed it, so it looks like it is going forward in the country. You keep hearing that more and more provinces are getting ready, and recreational legal marijuana use is coming, and that's reflected in the price of these marijuana stocks. This is Aurora. I've been bought into them last July and August, so I had an okay position, and then it exploded. I think there's still plenty of room to go on this one. Aurora is one of the top dogs, and is Aphria, as you can see here, it's in the 13.5 range, and I don't see any reason why Aurora can't compete to be up to that $20 range by next year. So I bought in again up here at $7.50, just because I had some money and I wanted just to stick it in there while I could. It's dropped down to 7 now, but I'm still happy with that buy. Aphria, I don't have as big a position. I was bag holding this one forever when I bought way back here, right on the peak, right when I discovered medical marijuana stocks. I bought 62 shares at $8, and then it dropped, and I've been bag holding and bag holding and bag holding, and then now just boom again since November. This one especially straight up. This company Aphria signed I think some kind of partnership with Shoppers Drug Mart here in Canada to be their supplier for medical marijuana sales. Yeah. So I'm still, those are my big positions. I guess my other two favorite is Katanga. This is the cobalt and copper miner in the Congo. I've loaded into them in anticipation of the electric car boom taking off here over the next 10 years and going forward. I started buying at 45 cents, and then I bought again in at 62 cents, and then this wave has just kept building and building and building, and I actually sold my whole position right out on the peak at $1.40. and the next day when the market opened, this stock started dropping. I waited until 125, right when it kind of came back to the center of the Bollinger Band. I bought back in with 100 more shares, so I got 1,000 shares in this company, but it's been slowly dropping. It had this big, huge drop and then bounced right back up, and I've been looking at it, and this whole range right here from when it skyrocketed up, came down, the bottom fell out, and then it came back up and slowly dropped. This mirrors this right here exactly, July and August. It peaked, went way up, peaked, kind of started coming down, the bottom dropped right out of it, came right back up, and then slowly trailed off, and then we went on a good 2 months of straight up. So I'm still optimistic on this stock. Nothing has changed. The only thing that's changed is that it came out that some of their books were wrong. So there's a class action suit from shareholders, which I don't understand. They're claiming they've lost all this value when, as you can see from the chart, no one's lost any money on this company. You've only gained. But nothing's changed. The mine's supposed to still be coming online again here this month, next month. They were shooting for Q4 of this year, and we're well into Q4. So I'm going to hold it 1,000. I'm sure that this stock, as soon as they start producing cobalt, which is going to be, is the main ingredient in the electric car batteries, I'm pretty sure this is going to be I'm going to get a healthy return off of this one again. American Manganese. I kind of caught wind of these guys. This is a electric car battery or a lithium battery recycling company, and I kind of caught wind of them, and I bought 1,800 shares at what you can see it's 16.5 cents, and not a week later, good article came out throwing some press on them, and it shot way up. And then I bought in again at 23.5 cents, and then it's kind of leveled off. Around that 20, 21. It was hanging out in that range for 2.5 months, and then they announced, what did they announce? Something came up. I'm not sure what happened. Something did. Oh yeah, their patent is going to be approved here. So they patent a process to recover 100% of the cathode materials, cobalt, lithium, etc., out of electric car batteries. So if you look at the supply constraints on cobalt and the metals needed to power this electric vehicle boom that's going to take off, and it's not just electric vehicles, folks. It's your iPhone, it's your computers, it's everything. They all need that kind of battery now. This company, I still say, is a definite get in now, because it's only at 28 cents. And if their pattern kind of holds like they do, and it's the same pattern going back to when they were under a penny, they'll shoot up and they'll level off. They'll shoot up, they'll drop a little and level off. This is kind of a big lull of nothing. The whole market kind of did this, at least the Canadian market this year. And then they shot up, leveled up, came down, leveled off, shot up. So that I think from now on out, especially since they're getting so close to, I think they got a pilot plant being built right now, and their patent should be approved and finalized here shortly. So I don't think there's anything but great things for this company. And then I still got the old rock steady, solid dividend paying stocks: Royal Bank of Canada, Fortis Inc., which is a power supplier, First National, which is a mortgage underwriter, mortgage supplier. And then I'm going to buy into these for Glencore for kind of the same reasons as Katanga. Glencore actually is I think owns 80% of Katanga Mining, but Glencore is going to benefit massively from the EV market as well as Vale. Vale is the biggest, I do believe, iron ore or steel. No, I think it's just iron ore. Yeah, they're the biggest iron ore producer in the world. It's a Brazilian company. And I don't see nothing but good things for them going forward. TD Bank. TD is, I think, is going to catch up to Royal Bank. They kind of always get kind of compared with each other, but Royal Bank's trading at $30 higher. So I think there's a lot of room for TD to grow. As you can see, this year they made some massive gains, $55 to $75, or 72 where they're hanging out now. And they have that low 13 PE, and they pay a nice dividend. And then this Iron Mountain, it's an American company. It's a REIT, but they sell, or what they provide is data storage centers. So their big hype, and I caught one of their articles that came across. What they like to propose is that their biggest customers are Fortune 100 companies in the States. So data storage, I don't know. You'd think that that's a safe bet. If you look at the weekly chart going back to 2012, that this chart doesn't look too pretty. It's lots of ups and big downs, big ups and big downs. But if you want to play the long game, if you look at this, going back to inception, it's still a 45 degrees nice chart. And they supply a nice, juicy 6% dividend. So those are the stocks that I'm in right now and that I'm looking at. And what else I need to tell you guys? So, since I'm a do-it-yourself investor, the year's almost out. So I've been in the market for a year. I've been researching. I've been doing my homework, trying to make good buys. And this application tells me that I made 44%, a 44% return so far year to date. Yeah, pretty much. I started investing December 2016, so it's a year in. So I did a 44% return this year. That's amazing. If you compare that with I don't know if their math is correct, because my math says I only got a $3,500 or a 35% return, and I think my math's more correct. I don't know how that application figures that stuff out. But where this is important, if you see right here, this is my investment plan through my work, and I'm down 20% just because this investment plan primarily is made up of the company's stocks, and it's an oil company, and we've taken a massive hit this year. So even though I've put in $8,600 into this plan, I'm down $3,700. So yeah, I'm down 20% there. The pension plan that my company offers, it's doing better. As you can see, like in the red here is the months where I took a loss, but overall it went up and up and up and up, and I made a nice 9.5% on that money. When you combine all my portfolios, I made a 5.5% return. But here's the kicker. My company just sold, and the buying company has no pension plan, no investment plan, no stock options, nothing. I get a 15% of my salary bonus at the end of the year, and it's up to me to manage my own money. And this is my lesson to you guys, is that if you were like me and your company was doing your saving for you and managing your money, I say that's a recipe for disaster, guys. I managed my own money and made 35% return. I let my company, with all their fancy financial planners, decide what my money was going to do, and I would have been up, but I would have made a whopping $1,300 off of those plans this year. No. And now, starting next year, I got to do it all myself. So it's my retirement, my future, my family's future is all up to my decision making month to month. Yeah, that's the breaks though. That's the world we live in. So I used to always kind of plan for my retirement, factoring in or giving myself a 4% return on my money per year. So starting 2018, knowing what I can do, I don't, and I'm not going to do a 35% return every year. So my plan going forward is to probably try to get about 10 grand in savings into my investment portfolio and manage it every year. 10 grand a year for the next 25 years till retirement. 25? 27. Yeah, because I'm 37 now. What? 37. Yeah, so 30, 20. Ooh, that's not even 30 years. Ooh, I got 30 years. Not even 28 years. 28 years to save. It's going to come fast. So I'm shooting now for an 8% return per year. That's my goal. I got to put in 10% or $10,000 into my retirement package, or not my retirement package, my investment portfolio, manage it, and make an 8% return per year. I think that's an okay goal. That is an achievable goal. I could do all my numbers and factor for a 10% return, but I think 8 is absolutely achievable. So I'm planning my future on an 8% return and investing 10 grand per year for the next 28 years. So I crunched the numbers, amalgamated everything, and by the time I retire, given that nothing else is going to change, but things will change, but all I can do is plan with how I can, with what I can do right now. I'll retire with $1.3 million in my holding account, in my brokerage account. And with that money, and it'll all be in dividend-paying stocks at that point, it'll all be in safe stuff, I can pay myself about $132,000 a year. And just watch, guys, this number per year barely moves. The first year, 13 grand. I will take out $132,000 out of this account, and my holding account, if I can still get that 8% return, will only lose $13,000. That's okay. That's not like uber wealthy. I'm not going to be balling by any means, but and this, you can factor in inflation, but I'll be comfortable. And I can get more aggressive with my withdrawing of my money, but I'd like to leave something for my kids, or my kid, I guess. I'm only going to have one. I'd like to leave something for my daughter, something nice and substantial, so that she can get ahead of the game. Because if I live to 85, my wife's a smoker, she doesn't exercise, she doesn't eat right, she'll probably, I don't know if she'll make 85. I'm planning to make 100. But if I live to 85 and die, my daughter will get, at current estimates, about $800,000. She puts that, if she's smart and I teach her how to manage her money and she can do an 8% return, she will do quite well. So that's pretty much everything that's changed, guys. Definitely this year has really stoked my fires on what the stock market can do. And I recommend that all of you guys, if you're not in it already, you get in it. Because I started when I was 37, and I can make, I want to retire with 1.4 million, and I'll be able to live off that. And I started late. If you're 20 years old and you still live at home and you don't have a lot of expenses and you can start doing this now, man, you're gonna have a good life. Anyways, that's all for today, folks. I'm sorry that it took so long to get this video out. Been busy. Christmas is here. I still want to try to make an investing video every week. I will still try to shoot for that, but if I don't, oh well, life is busy. I'll catch you next time. Peace.